We're delighted to have Salman Ahmed on the show today. Salman is the global head of macro strategy and strategic allocation at Fidelity International. Previously, Salman was the chief investment strategist and co-chair of the Global Investment Committee at Lombard Odier and head of global macro at EDF Trading. He was also an economist at Goldman Sachs and holds a PhD in economics from the University of Cambridge. Salman, thank you so much for joining us today.
Thank you. Thank you very much for having me. Really appreciate it.
We are only 2 weeks into 2026, and we've seen a stunning U.S. move in Venezuela and the worst protests in Iran, arguably since the fall of the Shah, which could still trigger U.S. intervention. It isn't easy really to trade on geopolitics, but is this a signal of further stress that could have impact in the markets?
Definitely. I think these are obviously very profound and foundational shifts in the geopolitical and the geoeconomic environment we are witnessing currently. And as you rightly pointed out, markets have struggled to price in geopolitical events. But the ongoing rally in gold, which has been in place for a few years now, has been reflective of this new world in some ways. A world which is based on low trust, a world where traditional relationships are under stress, and then reorientation towards a new world order, which is more defined by a hard power. Certainly a profound shift, and we also see starting to affect markets and investments. But these are long-term themes, not a short-term episode, although can seem quite intense in the short term.
You mentioned hard power, and I guess the United States for much of the post-war period relied on its soft power, that it was the head of a liberal Western alliance. Do you see that as sort of what we've seen with President Trump, certainly in Trump 2.0 in the second term, as a sort of a brief, perhaps unpleasant interlude, or is this suggestive of more of a leaning towards hard power overall in the global international system?
It's a very important, question and point. In sense, since World War II, as you rightly pointed out, U.S. willingly decided to be a rule based system supporter. So it basically created a system where it could, based on alliances after World War II. This was obviously led to the build-up of the multilateral institutions, both on the financial side, on the IMF, World Bank, and then you had obviously UN on the geopolitical side of things. But those commitments are under stress, and US is in fact reversed a number of those commitments, moving away from multilateralism to a more classical hegemon, which is basically that military capability and hard power decides the political outcomes and economic outcomes around the globe. And I think that foundation of that is the US-China rivalry, because China obviously has risen over the last 20, 25 years as not only economic power, but also a technology power and also a military power. So I think that foundational shift means that we are seeing a mean reversion, in the sense that US going back to how traditional hegemons or traditional superpowers used to act before World War I, World War II.
2025, you could argue, was the year of the Mag 7 and certainly the year of your AI, at least in the financial markets. But in the last quarter, there were growing concerns that we could have a potentially disastrous feedback loop in AI, with worries that these generative AI companies, the Anthropic and the OpenAI, won't ultimately have the revenue to pay for all the chips and the data center capacity that they've contracted to do over the next 10 years. And the market got into periods where they panicked a little bit almost. So what do you think of, the AI trade, so to speak, as we get into 2026?
So I think, as you rightly pointed out, as the capex cycles have become more intense, questions about ROI or return on investments and the expected revenue profiles of some of these investments are starting to become a big focus area. Interestingly, last year AI, as you said, was an important theme, but was not the only theme. Emerging markets did well, gold did well. There were other things happening as well. Financial sector or banks had a good run as well. So it was a more broad-based, dispersed environment, and and as we enter, these questions on the return on investment are going to become more important. Our teams, which are 180 plus analysts who work with different names in the industries, different sectors globally, are reporting, from an aggregate level, that AI thesis is real. Use cases are going to come through. You will have productivity gains. But yes, you can have wobbles because of somebody comes up with a better chip, somebody comes up with a better software. Like, for example, China Tech. That's one reason why we like China Tech, is because China Tech can hurt US Tech by producing better software, for example. So you need to diversify. You need to spread your bet, play that AI theme from a more broader perspective rather than this concentrated names. Uh, where valuations are, aggressive, but at the same time, we saw from the latest results, earning results, that the AI cycle is still running. There's still demand for capex, but yes, we are mindful that some ROI, return on investment question, comes in, which creates a wobble in the markets. Last point I would mention there is that we should also not forget that AI is a sovereign technology. So you will get government interest in that sector very quickly if something untoward were to happen. We are seeing that already in the defense sector in the U.S. Uh, President Trump administration has already intervened and trying to intervene in the credit card market with the cap on interest rates. So I would not be surprised if there's a wobble in the AI market, that the Trump administration comes in and does something about it.
Do you think that that governments need to figure out a way, via taxes or some kind of policy in that case, to ameliorate the changes that we see coming in with AI?
I think right now we are starting to see early signs of the impact AI is having on the job market, especially the job market of entry level jobs. So if that runs for 2 3 years and the problem widens, you can see a political pressure building up on the back of that, haves and have nots, right? System which will start to get created. So we have to keep an eye on, whether that helps the far left parties gain momentum. There's a lot of focus on right and far right parties, but far left is also equally getting popular in the background. So, so I think that's something we have to keep an eye on, because, as you said, governments are completely interested in AI. It is a sovereign technology. There is interest to make sure that the capex continues for defense purposes, if not for wider purposes, and it can become a more complicated and nuanced issue than I get AI, I will make more money. I think right now we are in that stage. It can become far more complicated than that.
You're absolutely right. I think I just saw a headline this morning that said, Trump wants the AI companies to help pay more for electricity because they're driving up overall the price of electricity, exactly. And that's just a signal exactly to as you say. You mentioned in the very beginning when we were talking about AI here that you perhaps should diversify and not put all your eggs in one AI basket. Are there, other than sort of the hyperscalers that we're familiar with, and some of these AI companies aren't directly investable for the general public yet. Are there places where we could invest in AI that's a little bit more off the beaten path, internationally perhaps?
Certainly, China Tech remains a diversifier. We have been obviously last year one of our high conviction ideas was Korean equities. So we benefited from that AI theme running in Korea with the semiconductor space. So we want to have exposure to the entire chain rather than some specific names. And also our portfolio managers are looking at the beneficiaries of AI rather than just the producer of those, AI compute. So who is going to benefit from the compute? We need to start looking at those names as well. So services sector where the AI disruption can happen can impact margins or help companies gain margins. So those are some of the themes we are looking at. But the market cap way of, as you said, 3, 4 names, I think the more this equity market goes up, the more dangerous it becomes because of the concentration and the lack of leadership right now we are seeing.
Any sectors that don't immediately come to mind that might benefit from this additional compute?
So I think we are looking at electricity providers, the grid providers, as a wider level. Then the supply chain of those grids we are looking at. So reorientation of some of the industrial names to cater to the AI data center demand, especially in Europe. There are a number of names who can do that. So it becomes a more stock selection game and across geographies. But yes, we do want to diversify across geographies, be mindful of currency. European equities did better than US equities in euro terms last year, for example. So, I mean, currency is a big differential between equity performances, and that is going to remain the case as well. So that's another angle to think of as we are thinking about having exposure to AI.
In the December 2025 edition of your Global Macro Insights, your team identified the sort of the obsolescence of the 60-40 equity bond allocation that was kind of de rigueur for some time. And you suggested 6 actions for today's fragmenting world. Active management, spreading risk, diversify, looking for income because of higher interest rates, getting involved in private markets, a built-in defensive posture, which includes, holding something like gold, as well as currency awareness, which you just mentioned. For the sophisticated retail investor, which is a lot of our sort of viewers, active management and private markets are a couple of things that are, probably the most hard to access. Any ideas in terms of how they can do that? Does Fidelity offer, sort of funds or vehicles that would provide some of that active management that we might need? And then, certainly private markets are something that may be difficult for people to get their hands on.
Sure. So I think broadly on active management, obviously, we are an active investment house, but we also have a range of other strategies which are looking at how to translate our research in a more systematic manner. So there's a range of how much active you want in your portfolios as well, we cater to. But at the same time, accessing private and public is something we are focused on. Because of the liquidity needs and profiles of private asset investing is quite different. And how does then that talk to your public assets portfolio? And then within private assets, how you can allocate in the different segments. As you mentioned, we are of the view that private assets have a very important role to play in your broader portfolios because bonds are no longer that diversifier we are used to having. And whether it's infrastructure, whether it's real estate, we are a bit careful about private debt right now in the US, careful about private equity because private equity is now moving the deals amongst each other and between their own funds, which is never a good sign. But it is not a systemic issue for us, but something as a warning sign to be careful about. But that's why the linkage between private assets and public assets has to be very clear and thought out. Because you are going to earn an illiquidity risk premium, but it is illiquid. And then you have to be then very careful about how you design your public asset portfolio to achieve the outcomes you're looking at.
Right. And on that note, let's move on to the Fed, which looks like certainly that it'll be on pause in January, and we have all this sort of certainly many of us think unnecessary fight about the about the independence of the Federal Reserve. The market seems to have priced one cut in the first half and another cut in the second half. From your view, how many cuts do you think the U.S. Economy will get? And I guess the magic question also for the more technical of us is, where do you think R star is in the U.S.?
Sure. I think how many cuts depends on who comes as the Fed chair
Mhm.
and how much influence the Trump administration gets on the Fed. Obviously, we have seen that uh, another move towards that with the subpoenas which were issued against Chair Powell, and obviously he reacted to that by saying that this is about monetary policy. So this is an open debate happening in the U.S. that how much Trump administration wants to influence monetary policy right now. But I think it goes without saying that next Fed chair is going to be very friendly to the administration. So it is possible that the Fed gets, sorry, the Trump, Fed does as many cuts the Trump administration wants it to. But it's not as straightforward because one person, one vote on the board. There are obviously cases going on with Lisa Cook case, Stephen Moran reappointment. Whether Powell will leave or not, the board is a big question. It's probably the reason why they went after him with this. Um,
That's
with
the
the
Pina, yeah.
subpoena. And I think that all that points towards a weaker dollar to our minds. But I think the worst case scenario here is that there's an open warfare between Powell and his allies in the Fed and the Trump administration. That's the worst case scenario. But we don't think that is a base case because there are, the one side may back off because the markets will get very unnerved by that kind of a scenario. But we are expecting going into midterms, quite a few number of cuts being done to make sure that the administration gets the help it wants.
I do want to move into something a little more U.S. specific, but certainly would affect, I shouldn't say that, it would affect the world in a big way, is the Supreme Court is supposed to rule on tariffs any day, and it is now becoming increasingly less clear how they're going to rule. I do think there's a real chance that they rule narrowly in favor of the president, to be conservative and also not, in some ways, to upset the apple cart. How do you think the broader U.S. stock market and markets react if the tariffs are overturned, and alternatively, which seems to be somewhat the expectation, alternatively, if they're not? What are the markets going to do sort of off the bat and longer term?
I think, as you pointed out, I think we can get a ruling on IEPA any day now. It's very likely it may get struck down given the comments which were made late last year. But the US government can rebuild that tariff wall using Section 301, Section 125. You can get to 15% quite easily with the other legislative instruments which are available. Um, the striking down of IEPA is a good thing in the sense that you will stop seeing President Trump changing them overnight because that's what IEPA allows at least in the current understanding allows the president to do. But the other legislative instruments means that you need to do investigations, you need to build a case, so it slows down the implementation, but it doesn't reverse it. So it can be rebuilt at least till 15%, which is near about what the effective tariff rate is. The average effective tariff rate. It can create uncertainty because that means that you have to rebuild everything. Sectors may get affected and so on and so forth. But the revenue is important for the US government because they're spending so much money on fiscal right now. And they want to spend more on defense. So this revenue is important. So this is not going to go away. So tariffs are here to stay. When it can create more uncertainty about in the short term, but they are not going to go away anytime soon. Now, what the Supreme Court ruling does, whether the revenues accumulated have to be paid back or not, that can also create some uncertainty around it. But there are some winners and losers out of it because China's tariffs, for example, are mostly under Section 301, so they won't get affected, but others may start getting affected, at least in the short term.
If investors were to remember just one or maybe two things, what do you want them to remember at this point in time?
I think the first thing is well done if you are invested in the US equity markets, the tech AI plays, they've done well, but it's time to assess how concentrated you are to that specific theme. As I mentioned, there are better ways to broaden out the exposure to AI geographically, look at the supply chains. Investing is going to get tougher from here because of geopolitics and geopolitical. It's not to say that please do not respond to every headline. Of course, that can be a bad investment advice, but be mindful of those longer term trends, like the dollar depreciation trend, the buying of gold, for example, by central banks. It's a low trust world, so you need to spread your bets intelligently, and diversification would help you do that. So look at the concentration in your portfolios. That's my main advice I'm giving to our investors right now.
One thing we didn't cover it, and it's been sort of and I do want to get your thoughts on it, is crypto. Crypto had a phenomenal move, and then a month later, Bitcoin looks like it's in deep trouble, and the MicroStrategies of the world, some of these folks are really struggling. What's your outlook on crypto?
So I think our outlook on crypto is that it is very much a long risk asset most of the time. So that means that its correlation benefit vis-a-vis other investing you're doing is pretty low, because it basically comes under pressure when equities come under pressure, for sure, but it comes under pressure itself as well. So it has these features which are coming out, especially at these price levels. So it depends on why you are, I think, getting involved in crypto. I think you have to be honest with yourselves. It is about technical moves. Then you can trade them, but the case for long-term investing at these levels is questionable, because you can replicate that same risk exposure through equities. Whilst gold, for example, does have those correlation benefits which crypto doesn't have, and last year was a very important evidence year of that. And please remember that central banks are not buying crypto; they're buying gold. So the manifestation of the low trust world is precious physical metal, not something digital which somebody can switch off. So it depends on why you want to get involved in crypto. I feel is quite important.
Salman, thank you so much for joining us today. Really appreciate it. It's going to be very useful for our viewers to, as they think about, their portfolios and how concentrated they are. I think Fidelity is going to offer a lot of interesting options for them. So looking forward to our next conversation. Thank you so much.
Thank you for your time. Really appreciate it.